This is the man that turns mathematics into the greatest money-making machine in history. His name is Jim Simons, and we're going to go over how he mastered trading using this one truth. Now, you've probably seen his name online, but how exactly did he actually do this? In this video, I'm going to show you how Jim Simons mastered trading and broke through every limitation that held traditional traders back, beating everyone on Wall Street at the same time by achieving 66% average returns for over 30 years. Here is his returns actually by year. You can see before the commission the actual hedge fund takes, the return is 66%, but net returns after that commission is 39% over those 30 years. Now I'm going to tell you why he became the most successful trader in history by asking one simple question. What if the secret to consistent profits wasn't genius intuition, but actually raw data? Simons understood one fundamental truth that every other trader at the time completely missed. Edge is the only thing that matters, and that often comes from data. While everyone else was relying on gut feelings and market intuition, Simons built models, tested them rigorously, and refined them based on pure data alone. He applied the scientific method to markets before anyone else had even thought about. And if you've wondered how systematic or quant trading actually works at the highest level, or whether data-driven approaches can really beat human intuition, this is exactly how he proved it. So much so that it's helped me become profitable by running 10 automated strategies in futures and in crypto markets. Let me play one quick clip of Jim Simons for you. That will be the lesson that we are diving deeper into today.
Investing firms say, oh, they have models. And what they typically mean is, we have a model and it advises the trader what to do, and if he likes the advice, he'll take it, and if he doesn't like the advice, he won't take it. Well, that's not science. You can't simulate how you would do. How were you feeling when you got out of bed, 13 years ago when you're looking at historical simulations?
Now, what is the scientific method and how do we actually apply it to trading? Well, the scientific method in trading starts with one fundamental question. Why would this strategy make money? This is your hypothesis. As with any science experiment, you have to start with a hypothesis beforehand. Are you taking on a risk premium? And that primarily means you're getting compensated for some sort of risk that you're taking on. Are you exploiting a mispricing? Are you capturing momentum that persists due to X thing? You can actually also check out my latest podcast where we dive deep into understanding different types of ways to make money in trading and their pros and cons. But once you actually have this hypothesis of what you're trying to test, you want to codify the rules with zero discretion. This means defining everything, such as your exact entry conditions, your exit conditions, position sizing methodology, stop loss levels, which instruments you're going to qualify over. Is it going to be the whole market? Are you going to have a filter over it, etc.? No visual chart reading, no manual overrides, no I'll know it when I see it, those sort of things. If you want to be systematic, you have to define things. And simply put, if you can't write it down as code or at least as like an Excel sort of formula, it's not systematic enough. Here's an example of why this matters. Now, this is going to be a really crude and easy example for you to understand, but obviously this can get more complex when you're kind of blurring the lines. But let's say you're trading an opening range breakout system. You need to specify the exact time window that refers to the opening range. This could be the first 5 minutes, this could be the first 15, but you'll need to at least pick an initial one. Obviously in the future, you can optimize over that if you want, but this is a very easy example of how you're stating something that you're going to, have a breakout over an opening range, but you need to first quantify what that actually means. Is it the first 5 minutes? And does that mean the candle has to close above the high, for example, of that opening range? Or can a wick include it? All those sort of things. Now, once we have our hypothesis that we want to test, we want to build a realistic way to test that. This is probably where most traders fail. They backtest in a fantasy world with no costs and perfect fills. You want to include realistic commissions and fees. Apply slippage on every entry and exit. Assume you're not getting the exact price you see. You can use conservative assumptions for your exits as well. If your strategy can't handle realistic trading costs, it won't work live, simply put. And this is probably like the most simple thing, but I see it hand on heart so many times. Someone will send me a backtest and I'll ask, hey, have you included, slippage and commissions? And they'll say no. Or they'll say, well, I've added one tick and they're trading on the 30-second chart. Like that, that's not really going to realistically happen when you actually execute. Now, this might actually surprise some of you, but then I'm going to actually add more of this. I'm serious. Make your assumptions worse. Increase your slippage. Maybe do it by 50 or 100%. Test what happens if your stops execute at the worst possible prices. If your edge or hypothesis can survive these pessimistic assumptions, it only means it's more robust. And this is going to be a word I'm going to be saying over and over in this video because it's one of the most important things to building systematic strategies that actually work. Next, you'll want to test for how fragile this is. One of Simon's key insights was understanding sample sizes. Renaissance analyzed terabytes and terabytes of market data when others were eyeballing charts. And I'll actually let him tell a quick story of how they hand collected data before really anyone else.
And, bringing in data. In those days, we sent gals down to the New York Federal Reserve to copy histories of interest rate numbers. I mean, they didn't exist in the 70s. You couldn't go and buy data, and there was certainly not online deliveries of all this stuff. So to build the original models, we needed to collect a lot of data.
They understood what statisticians know. Larger samples reveal true patterns hidden in noise. A backtest of 20 trades means absolutely nothing. You need thousands or at least hundreds of samples to distinguish signal from noise. But it's also not just about the quantity, it's about the variety of it as well. You want to be able to test your strategy year by year. You want to do it in bull and bear markets, in quiet and volatile periods. And you also want to test for those major stress events. This will be a great way to help understand how robust and if your position sizing methodology can survive those stress events. Next, you want to probe for sensitivity. You could maybe shift your entry times forward and backwards by a few seconds or minutes, or by a candle if you're just using, for example, you're entering on the 2-minute candle. If the performance collapses with very minor delays, your setup is probably too fragile for real execution. Markets don't always give you the perfect timing, especially if you're trading something on the lower time frame. It can be very easy for there to still be some lag or partial fills on execution. Another key part is move your key parameters up and down, change your volume thresholds, your indicator values, profit targets, stop losses, all of those. If tweaking one parameter by 10 to 20% destroys your returns completely, you're probably curve fitting to historical noise. An easy way that I test it for it is using a heat map. So I'll just zoom in on this really quickly. As you can see, there's 2 period lengths that we're testing for. So we have one look back and then we have one for an indicator. And then what you can see here is the deeper blue it is the more profitable it is. So the final equity value. And the more yellow it is, the lower the actual value is. So you can see there's kind of a cluster around here of things that are most profitable. Now, the only one that I would say that's dangerous around this one is if you flip it from 40 and 40, and then you go 40 to 50, the results dramatically drop off. So that can be a warning sign. It does have more stability around this sort of region, but ultimately what you're looking for is primarily you want to have a maxima. So let's say it's here, and you'll want it to have, an encompassing range all over here, where the region slowly falls off. If you're getting things where you're getting 1 dot over here, 1 dot over here, 1 dot over here, you're probably just picking lucky parameter values, and that's why you're getting that historical performance. Let me just quickly zoom out. You want to set your criteria based on what the strategy type should produce. So once you've tested this, we've gone through the initial backtesting after we had planted out a hypothesis based on whatever idea or strategy idea you wanted to test. You're then obviously going to see the performance metrics and the results of that backtest. But how do you know if those performance metrics are actually good? And the key thing here is before you run any test, you need to understand what good performance looks like for that specific type of strategy. For example, trend following strategies will often have lower win rates, often around 20 to 40%, but they need higher risk to reward ratios to actually make that profitable. You should normally expect big jumps in the equity curve from occasional large winners in trend following. But if your trend system has a 70% win rate, something is probably very wrong with that. Mean reversion strategies are actually the complete opposite. And I can kind of quickly draw you out how it looks. So for a trend following strategy, you're going to have slowly losing, then you're going to have a jump with one large winner. Then you'll be slowly losing, and then you're going to have a jump. Slowly losing, and then you're going to have a jump. That's normally how most trend following systems look. Whereas mean reversion is the complete opposite. So mean reversion is going to be slowly going up, compounding very well, and then a sudden drop. And then it's going to be slowly going up, blah, 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 and then sudden drop. And it's often because the mechanics of how they work. Mean reversion strategies, you're often going to have larger stop losses. You're going to have some sort of pyramiding normally in them because you're adding to it as it gets further away from the mean. And often, 1 out of 10, 1 out of 100 that don't actually revert to the mean, that's where you're going to hit your biggest loss. And that's where it's going to be a sudden drop in your equity curve. Whereas trend following is complete opposite. You're going to be losing a lot of times, taking small losses, and then one particular trade will pay 10x fold. Both of these strategy types work, but let's say you didn't know this. If you looked at the performance metrics or the equity curve of either one of these strategies, you could think there's something wrong. Like, why is it doing this suddenly? And why is it dropping suddenly? This strategy potentially could look really bad if you're thinking, oh, sudden drops in equity. Depends on what your risk tolerance is, but they both have their pros and cons. Now, this is why mean reversions, typically have a higher win rate, as I was saying, around 60 to 70%, but they're going to have smaller average wins relative to losses. And as I kind of already just showed, the equity curve will grind up steadily rather than making large jumps, and then it'll have a large drop most of the time at different points. The point is, You don't want to apply the same pass and fail criteria to every strategy, because some strategies, especially if they're on more volatile assets, will have higher drawdowns compared to others. Now you might be saying, why don't you just look at everything then on a Sharpe ratio or on a Sortino ratio? Those are great performance metrics, and they do give you a good amount of the story. Even a high Sharpe strategy can ultimately blow up in the future because you're taking on too much like fat tails risk, for example. Also, there's the whole part about your risk tolerance. You can have a very good Sharpe ratio, but you could still have a 20 to 30% drawdown. And is that something you're comfortable with? Are you wanting to go for a smaller, percent drawdown? Can you actually handle more? All those sort of things. So you're going to want to view it on a basis of all the different types of performance metrics. And most importantly, you want to ask the question, does the strategy performance profile match what I expect from this type of hedge? This can go into kind of more complex methods, but you want to see like, are the winners and losers distributed in a way that makes sense? Does the equity curve behave in the way that it should, etc. If they don't align, then that's actually quite a big red flag, because that probably means you're curve fitting to something rather than capturing a real edge or what you were planning to capture. For example, I'll see some people send me that they have a trend following strategy that has a 90% win rate. Well, most of the time I know that's completely overfitted, because out of history of all the best quants and even some of the best trend following funds, I've never really seen anything with a trend following with 90% win rates. Also, it doesn't really fundamentally make sense of how trend following strategies work. You may have captured something completely different. It could be something that works, but a lot of the time it's going to be curve fitting or overfitting to historical data. And ultimately, most people like to skip this process because it's hard, it's tedious, and it kills most of your ideas. It's not a very enjoyable experience overall. But more importantly, it requires actually understanding what you're trying to capture and not just optimizing for the highest backtest return. I know that sounds like a really simple sentence, but a lot of systematic traders that I see come into the space, they really get messed up on this, where they're only looking for the highest backtested return when backtesting. And if you're having that as your main focus of how you're trying to like build a strategy, it most of the time just leads to overfitting. Obviously, yes, we all want a high returning, strategy. That is obviously the goal. But when you have that as the fixated thing at the top that you'll keep on optimizing for, you keep on testing new things, you keep on adding new parameters to try and get it even a higher backtest return, most of the time you're just left with disappointment when you actually take it live. And Simons understood this. He understood that removing emotion from trading wasn't just about execution, but it was also about removing it from the entire research process. While most traders were making decisions based on gut feelings and recent experiences, they were running thousands of simulations with brutal objectivity. As Simon said, we don't override the models. And this wasn't just about live trading, it was about the entire methodology.
If you're going to trade using models, you just slavishly use the models. You do whatever the hell it says, no matter how smart or dumb you might think it is at that moment. And that turned out to be a wonderful decision.
When the data set and idea didn't work, they moved on, no attachment, no ego. I've had to dismiss hundreds of strategies that haven't worked for me, and it's just part of the process. Now, I will say over time you get better, because once you understand these strategy types and different ways you can make money in markets, most of the time different strategies will fall into one of those sort of categories. And this leads me perfectly into the next part, is the power of diversification. Here's another truth Simons understood very early on. One strategy will not last forever. Every alpha fades over time as more people discover it or the market conditions change. This is why Renaissance had a consistent focus on research. They weren't looking for one perfect strategy, they were building a portfolio of edges. This is actually related to a video I created around the Holy Grail, and it's primarily around combining multiple different signals or strategies that are somewhat uncorrelated and how that can improve your risk-adjusted return. And how that sort of works is that some of these strategies that you create will work this month, others will work next month. Some capture momentum, other capture mean reversion, some trade stocks, other trade currencies or crypto or whatever. But having that diversification leads you to often have a smoother equity curve and better risk-adjusted returns. And it means you're not reliant on just one approach working, because that can be very stressful if just one approach, for example, is not working this month and you're just losing money and there's nothing you can really do. This is also evident in when Simon said, we have 3 criteria. If it's publicly traded, liquid, and amendable to modeling, we trade it. Which means if there's anything out there in the world which has public data, or at least is, publicly traded, has liquidity, meaning you can push a decent amount of size, and is amendable to modeling, meaning it has data behind it that you can extract and find ways to do that, then obviously they trade it. And I take a similar approach. I don't trade as diverse as possible, but I do trade right now futures, crypto, and then also some equities as well. Most traders, especially from my experience, limit themselves to one market, even one time frame, and one style of trading. They become attached to being a day trader or crypto trader or whatever X trader. But the best approach is going where the alpha is and combining multiple different uncorrelated strategies. There's nothing wrong with starting out with one market. I totally understand that, and that's the same thing I did when I was starting out. But as you evolve over time, it is better to diversify and add different approaches to it. The truth is, building profitable systematic strategies isn't about finding the perfect indicator or magic parameter. It's about applying rigorous scientific thinking to every idea. State your hypothesis clearly, code it without discretion, test it brutally, and then kill it if it doesn't work. And if it does, and you've got through this whole video and you have a strategy that's working well after your testing, deploy it live, normally scale it up slowly. I wouldn't say put the full capital on it straight away. And then from there, just go on with this research process, find another strategy, add it that works well in the portfolio, and keep on scaling.